cold open. In September 2019, Adam Neumann was worth $4 billion on a Monday. By Friday, he was fired. The company he built, valued at $47 billion just weeks earlier, was days away from running out of cash entirely. Employees had no idea. Investors were in shock. And the man at the center of it all, he was already negotiating his exit package. What happened in between is one of the greatest financial illusions Wall Street ever let through the front door. Setup. Let's go back to where this starts. Not Silicon Valley, not a garage. A small apartment in New York City, 2008, the same year Lehman Brothers collapsed and the global economy nearly broke in half. Adam Neumann was a 29-year-old Israeli-American entrepreneur with big ideas, bigger energy, and almost no money. He'd already tried and failed with a collapsible heel women's shoe company. Before that, baby clothes with knee pads. Not exactly the profile of a man who would one day shake hands with Masayoshi Son and walk away with $1.7 billion. But Neumann had something most founders don't. He didn't just sell products. He sold feelings. He sold belonging. He sold the idea that going to work could feel like joining a movement. In 2010, he co-founded WeWork with Miguel McKelvey in a single building in Soho, Manhattan. The pitch was simple. Rent large office spaces, divide them into smaller units, sublease them to startups and freelancers at a premium, and pocket the difference. A real estate arbitrage play dressed up in the language of community and consciousness. On paper, it was a landlord business. But Neumann convinced everyone, and I mean everyone, that it was something else entirely, something worth $47 billion. Build. The early years worked. WeWork grew fast. By 2014, the company had locations across New York, San Francisco, and London. Revenue was climbing. The vibe was real. Young founders wanted to work there. The spaces were beautiful. Exposed brick, kombucha on tap, phone booths for private calls. It felt like the future of work. And then the money arrived. In 2017, Masayoshi Son, the founder of SoftBank and the man behind a $100 billion vision fund, flew to New York. He and Neumann reportedly met, toured a WeWork location, and within 12 minutes, Son decided to invest. Not millions. Billions. SoftBank eventually poured $10.65 billion into WeWork, making it one of the most heavily funded private startups on Earth. Masayoshi. Son was not a naive man. He'd backed Alibaba at $20 million when nobody wanted it, and watched it become worth hundreds of billions. His instincts had made him one of the wealthiest people in Asia. But something about Neumann, the charisma, the certainty, the sheer scale of the vision, bypassed his filters entirely. Son reportedly told Neumann during that first meeting, "In a fight, I always bet on the crazy one." He thought Neumann was the crazy one in a good way. He was right about the crazy, wrong about the good. With SoftBank's billions fueling the rocket, WeWork expanded at a pace that defied logic. By 2019, it was operating in 111 cities across 29 countries. It had 527 locations worldwide. It was the largest private tenant in Manhattan, London, and Washington, D.C. simultaneously. The headcount went from hundreds to 14,000 employees in under 4 years. And it was burning cash, catastrophically. In 2018 alone, WeWork lost $1.9 billion on $1.8 billion in revenue. Read that again. They spent more money than they made by nearly $1 billion in a single year. In 2019, the losses were accelerating. The company was hemorrhaging $219,000 every single hour of every single day. But here's the thing. Nobody outside the inner circle knew how bad it really was. Because WeWork was private. No public filings, no quarterly earnings calls, just the numbers Neumann chose to share. And the metric he invented to make them look better. He called it community-adjusted EBITDA. Standard EBITDA strips out interest, taxes, depreciation, and amortization. Neumann's version also stripped out basic operating costs, marketing expenses, and growth investments. By his own custom math, WeWork was profitable. By every accepted accounting standard on Earth, it was one of the fastest cash-burning companies in American history. And then came the S1. In August 2019, WeWork filed its IPO prospectus, the document that would finally let the public see inside the machine. And what they saw was jaw-dropping. The filing revealed that Neumann had personally trademarked the word "we" and then sold that trademark back to WeWork, his own company, for $5.9 million. He had borrowed hundreds of millions of dollars against his own shares, using the company as collateral. He had sold stock while simultaneously promoting investment. He had leased buildings he personally owned back to WeWork, collecting rent from the very company he ran. The conflicts of interest were not buried. They were right there, in black and white. Hundreds of pages of them. Wall Street read it and recoiled. Analysts who had privately whispered doubts for years suddenly said them out loud. Within weeks, the target IPO valuation collapsed from $47 billion to $20 billion. To defer market server. Fifth three. Then talks of $10 billion. Then the IPO was pulled entirely. The company that was supposed to list publicly by make Neumann the wealthiest man in New York never made it to the market. Revelation. Here's where it gets truly dark. WeWork was weeks away from running out of money. Not months. Weeks. Without new capital, 14,000 employees would have no paychecks. Thousands of business tenants would lose their offices. Leases signed in 29 countries would collapse. The board moved fast. In September 2019, they forced Adam Neumann out as CEO. He left with $1.7 billion. Let that land. The man who drove the company into near bankruptcy, who invented fake accounting metrics, who sold his own trademark back to his own company, he was paid $1.7 billion to walk away. SoftBank gave him $500 million to surrender his supervoting shares, covered $430 million in personal loans, and handed him a $185 million consulting contract that was later clawed back. Meanwhile, WeWork employees, the ones who believed in the mission, who turned down other jobs, who held stock options they thought would make them financially secure, got almost nothing. The company laid off 2,400 people in November 2019. Their equity evaporated. Their options were worthless. Some had worked there for years. Neumann went to the Maldives. The company that promised to elevate the world's consciousness had just destroyed the financial futures of thousands of people who trusted it. Takeaway. So what do we actually take from this? Because there is something here beyond just shaking your head at billionaires. The WeWork story is a masterclass in how narrative beats numbers until it doesn't. Neumann didn't just sell desks, he sold an identity. And when you buy an identity, you stop asking whether the math works. Every major investor who backed WeWork had access to the same financial data. They chose to believe the story instead. That's not unique to venture capital. It happens to regular investors every single day. In stocks, in crypto, in real estate. When a founder, a company, or an asset class makes you feel something, your critical thinking goes offline. The one tool that protects